Okay, let's unpack this. Today, July 4th, marks a truly significant moment in American policy.
Hmm.
President Trump is uh, poised to sign what's been dubbed the One Big Beautiful Bill Act.
Right.
This isn't just any piece of legislation. It just barely squeezed through Congress and is set to bring sweeping changes across nearly every aspect of American life.
Yeah, everything from your personal finances, how you pay taxes, to major industries, even social programs. It's huge.
Exactly. And for those of you who've been tracking American policy, what's truly astonishing about this One Big Beautiful Bill isn't just its name.
No, it's the scope, isn't it?
Fact.
How comprehensively it seeks to reshape nearly every corner of our financial lives.
It really does. It touches everything from individual tax rates and business investments to social safety nets, even how we approach clean energy.
It genuinely reshapes the financial landscape for, well, at least the coming decade.
Right. And for you, our listener, the mission of this deep dive is really to cut through the noise.
Mhm.
We'll explore the core elements of this bill, what it means for the economy, for different groups of people.
Yeah, help you understand the most important nuggets of information. There's a lot of details surrounding this new law.
It really is. So let's get right into it.
Okay.
So the central subject today is indeed the One Big Beautiful Bill Act, or OBBB, as some are calling it.
Right, the OBBB passed yesterday, July 3rd, after some pretty dramatic votes.
Yeah, razor-thin margins, weren't they? In the House, it was 218-214.
Mm-hmm. And the Senate was even tighter, 51-50. Needed Vice President J.D. Vance to cast the tie-breaking vote.
Wow. So the White House is framing this as delivering the largest tax cut in history for middle and working class Americans.
Yes, and the start of a new golden age is the phrase they're using.
But there's another side to this story, of course.
Always is. Critics have voiced significant concerns, mainly about, well, the national debt potentially increasing.
And cuts to health coverage. I heard millions could be affected.
That's a major worry, yes. And, the way this legislation was even brought to a vote is pretty key to understanding the context.
How so?
They used a process called budget reconciliation.
Ah, reconciliation. That's the fast track, right? The one that lets you bypass the Senate filibuster. Avoids the 60-vote hurdle.
Precisely. But it comes with strings attached, notably the Byrd rule.
The Byrd rule.
Yeah.
Remind me.
Think of it like a gatekeeper for these reconciliation bills. It essentially says, look, if you're going to use this fast track, your provisions must directly impact the budget, revenue, or spending. You can't just sneak in unrelated policies.
Okay.
And you can't add to the deficit beyond a certain time frame, usually 10 years, and definitely no tinkering with Social Security.
So it keeps the focus squarely on fiscal matters.
Right. Allowing passage with just a simple majority, which is exactly why we saw that 51-50 vote in the Senate.
Got it. Okay, now let's pivot to the tax implications. For many listeners, this is where the rubber truly meets the road. Specifically, what happens with the 2017 Tax Cuts and Jobs Act, the TCJA? That was originally set to expire, wasn't it?
Most of it was, yes. And the OBBB makes most of those 2017 TCJA provisions permanent.
Permanent. Wow. What are the major implications of that?
Well, it's a monumental shift. Making the TCJA permanent means a projected decrease in federal tax revenue.
Decrease. By how much?
By an estimated $4.5 trillion between 2025 and 2034.
Trillion. With a T.
With a T. Now, the potential upside for the economy is that long-run GDP is expected to be about 1.1% higher.
Okay, so there's growth.
Yes, and that growth would offset about $710 billion, maybe 16% of those revenue losses.
But I sense a but coming.
There is a but. It's worth noting that the long-run gross national product, which measures American incomes.
Right, not just economic activity within the borders.
Exactly. That only rises by 0.4%.
Hold on, 1.1% GDP, but only 0.4% GDP? Why the difference?
That 0.4% GNP rise compared to 1.1% GDP is a really critical distinction. It reveals something stark.
Which?
Much of the economic growth from this bill might not fully benefit American citizens.
So where does it go?
A significant chunk could flow out of the country to foreign investors due to higher interest payments on the increased debt.
So we're borrowing for growth, but some of that benefit goes overseas.
In essence, yes. We're borrowing, and part of the return needed to service that debt goes to foreign holders of that debt. It's subtle, but powerful.
Okay. And on the individual level?
Well, permanence is a positive for about 62% of taxpayers who would have otherwise faced tax increases when the TCJA expired.
But the drawback is?
The drawback, as critics keep pointing out, is that conventionally it adds $4.5 trillion to the budget deficit, and that significantly pushes up interest costs for the government.
Right, that debt concern again. Okay,
Yeah.
Shifting gears slightly, but still on the business side. 100% bonus depreciation.
Oh, yes, another big one.
What does that actually mean for investment? How does it impact, say, commercial real estate investors or manufacturers?
So this provision, which had already started phasing out, is being fully reinstated, back to 100%.
Okay, and what does it let businesses do?
It allows property owners to claim 100% depreciation upfront for qualified property. Basically, deduct the full cost immediately.
Instead of spreading it out over years?
Exactly. Instead of spreading those deductions over the asset's life. This applies to property acquired and placed in service after January 19, 2025 and before 2030.
So it's retroactive a bit.
Yes, back to Jan 19 this year. Remember, before this bill, that 100% bonus depreciation had started phasing down in 2023.
Right, it dropped each year.
Yeah, by 20% annually. It was scheduled to hit just 40% in 2025, so this is a big reversal.
So for commercial real estate, for manufacturers building new facility?
It means full, immediate expensing for that new construction. Deduct it all now. It's designed to incentivize immediate business investment.
Makes sense. Now, the bill's ambition for business doesn't stop there. There's Section 199A, the deduction for pass-through businesses.
Another cornerstone of the 2017 tax cuts.
This one's been pretty debated, hasn't it?
It certainly has. Section 199 lets individuals, estates, and trusts deduct 20% of their qualified business income, or QBI.
From pass-through businesses. So we're talking sole proprietors, S-corp, LLCs.
Exactly. Your local doctor's office, a freelance graphic designer, a plumber, a family construction company, places where profits pass through to the owner's personal tax return.
Gotcha. But there are limits, right, based on income and type of business.
Yes, it's subject to limitations. For instance, specified service trades like law or medicine have different rules that kick in once income thresholds are crossed. It can get complicated.
And the argument for it is that it encourages growth, right? Levels the playing field with corporations.
That's the proponent's argument, yes. Encourages growth, narrows the tax gap between corporate and pass-through profits.
But what does the data actually show? Has it worked?
Well, that's the core of the debate. Critics counter that there's really no strong evidence it has actually led to significantly increased investment or job growth. They also argue it's needlessly complex for many small business owners, potentially inefficient because it benefits old and new investments.
A windfall for existing stuff, maybe.
Could be seen that way. And it's costly. Projected revenue loss of about $258 billion from FY 2022 to 2026 just from this one provision.
So has anyone studied the actual impact?
Yes. A 2022 study looked back at 2018, the first year it was available. It found, and I quote, "no large response in taxpayer behavior or business investment and hiring."
Interesting. So intended to spur activity, but the real-world impact is murky.
Subject of ongoing discussion is probably the fairest way to put it.
Okay, let's shift focus now. While the bill significantly reshapes business and taxes, its impact goes deep into American families and social support.
Very deep.
Let's start with the child tax credit, the CTC. What's changing there, and maybe more importantly, who really benefits from these adjustments?
Right. The Senate-passed version includes some notable changes. It increases the maximum credit from $2,000 to $2,200 per qualifying child under 17.
Okay, a $200 increase.
Yes, and it will be indexed to inflation going forward. However, and this is a crucial detail, that $200 increase applies only to the non-refundable portion of the credit.
Non-refundable, meaning?
Meaning it primarily benefits middle and upper income families who already earn enough to have a federal income tax liability to offset. They already qualify for the full credit.
So, wait, families with lower incomes, maybe working part-time, minimum wage, they won't see that extra $200.
Unfortunately, that appears correct for many. If they don't earn enough to owe federal income tax or enough to get the full refundable portion under the current phase-in rules, that extra $200 non-refundable credit doesn't help them.
That seems counterintuitive if the goal is helping working families broadly.
It does raise questions. Researchers from Columbia University actually noted that as many as 1 in 3 children could be ineligible for this extra CTC amount simply because their family's income is too low.
Wow. 1 in 3.
Yeah. And there's another restriction too. Parents or guardians must have valid Social Security numbers to claim the credit.
So that bars most non-citizen parents, even if their kids are U.S. citizens.
That seems to be the effect, yes.
Okay, let's move to one of the most talk about new ideas in the bill, something totally novel. The Trump accounts for babies.
Right, this has generated a lot of buzz.
It sounds fascinating, maybe even revolutionary. But what are they exactly? How would they actually work for a new family?
It's an innovative concept for sure. These Trump accounts are basically government-funded investment accounts for every new American baby.
Government-funded, how much?
They start with an initial deposit of $1,000.
Okay, $1,000 seed money. Who gets it?
It would be for U.S. citizens born between January 1st, 2025 and December 31st, 2028. Big caveat. Their parents must have Social Security numbers.
Right. Can families add more?
Yes, there's an annual contribution limit of $5,000 that families can put in.
And the money just grows. Can you take it out?
It's designed for long-term savings. There are withdrawal restrictions until age 18.
What can you use it for then?
At 18, it can be used for specific things. Higher education, starting a small business or farm, or buying a first home.
And after that?
Full access to whatever's left becomes available at age 31. And any distributions are taxed, but at the lower capital gains rate.
So it's essentially a form of baby bond aimed at wealth building from birth.
That's the idea, yeah. Introduce investing early, build wealth, leverage compounding interest.
What do economists think about this kind of thing generally?
Generally, economists tend to support the concept of baby bonds or child development accounts. That initial $1,000 seed money. Estimates suggest it could grow to maybe $8,000 after 20 years, even without extra contributions.
Just from compounding.
Just from compounding. And the automatic universal design is often praised for its potential equity benefits, giving every child some financial start.
But are there concerns about this specific Trump account design?
Yes. Experts have raised a few practical issues. One is just the mechanics for financial institutions. Managing millions of individual accounts, potentially with small balances, can be costly for banks. Some suggest a pooled structure, maybe like 529 college savings plans or the federal employee TSP, might be more viable administratively.
Makes sense. Other concerns?
Tax treatment is another. It's less favorable than 529 accounts, which offer tax-free withdrawals for qualified education expenses. Here, withdrawals are taxed, albeit at capital gains rates.
So lower-income families might face taxes if they need the money early for something else.
That's a risk, yes. If they need it for non-qualifying expenses, they could face higher taxes than expected. And finally, there's a worry about wealth inequality.
How could it worsen inequality?
Well, if wealthier families contribute significantly more, the gap could widen. And there's a question of whether having this asset might reduce eligibility for other means-tested benefits, like SNAP or Medicaid down the line.
Speaking of which, this bill isn't just about taxes and new savings accounts. It also includes pretty significant shifts in social support programs like Medicaid and food stamps, right?
Absolutely. Significant shifts. And for many, significant reductions or new hurdles.
So for our listeners, what are the winners and losers here, particularly for lower-income Americans relying on these programs?
Well, the bill enacts deep reductions in some areas and introduces new requirements. For Medicaid, the big one is imposing federal work requirements.
Work requirements for Medicaid. Who does that apply to?
Able-bodied adults under 65 who don't have young children. They'd need to document 80 hours a month of work, volunteering, or job training to qualify.
And the impact.
The Congressional Budget Office, the CDO, estimates that millions could lose coverage or assistance as a result of requirements like these.
Millions.
Millions.
Yeah.
And the American Hospital Association has warned this could cause, quote, irreparable harm to hospitals, particularly those serving large Medicaid populations.
Wow. And for SNAP, the Food Benefit Program, similar tightening.
Yes, tighter rules there too. States with high error rates in administering SNAP will be required to pay more starting in 2028.
So putting it all together, the CTC changes, the potential impact of Trump accounts on benefits, the Medicaid and SNAP changes. What's the net effect on low-income households?
It's not looking positive overall for that group. A Penn Wharton analysis projected that individuals earning under $18,000 a year could actually see their after-tax income fall by about $165 annually under this bill.
Fall, despite the narrative of broad tax cuts.
Fall, yes. It highlights a significant potential impact on some of the lowest income households, potentially widening the gap, not closing it.
Okay, let's switch gears again. Energy. The bill also has big implications for the clean energy sector, electric vehicles.
Major changes there too.
For anyone thinking about putting solar panels on their roof or maybe buying an EV, what's happening with those tax credits?
The bill scales back those incentives quite significantly. Let's take residential clean energy first. That's the solar tax credit for homeowners.
Right. What's the change?
The Senate bill proposes a pretty rapid phase-out. It would drop from 30% in 2025 down to 18% in 2026, then just 6% in 2027, and poof, 0% in 2028.
0 by 2028. That's fast. Wasn't the House version even faster?
It was. The House had proposed an abrupt end right after 2025. So the Senate version is slower, but still a very significant reduction compared to current law.
And for commercial solar, businesses putting up larger installations.
The investment tax credit, the ITC for commercial solar, that stays at 30% through 2028, but then it also phases down, hitting 0% by 2032.
Are there new strings attached to these credits too? Things that might affect projects?
Absolutely. There are new requirements about when projects have to start and finish.
Like what?
Projects must begin construction within 60 days of the bill's enactment.
60 days, that's tight.
Very tight. And they have to be placed in service, basically up and running, by December 31st, 2028.
What's the reaction been to that timeline?
Industry advocates have heavily criticized it, saying it's way too compressed, especially for large-scale project planning. It could stall projects already in the pipeline.
Anything else on solar?
Yes, a big one for residential. The tax credit would no longer apply to third-party owned systems.
Meaning leases or power purchase agreements, PPAs.
Exactly. Those models where a company installs the panels and you pay them for the power, often with little or no money down.
That could hit lower-income households hard, couldn't it? Since they often use those models.
That's the concern, yes. It could make solar less accessible without a large upfront investment.
How's the market reacted?
Not well. Solar stocks took a nosedive after the House vote. Sunrun was down 41%, SolarEdge down 26%, and Phase Energy down 18%. Big drops.
Wow. And electric vehicles, EVs.
The big $7,500 tax credit for buying a new EV, that's ending after September 2025.
September 2025. Wasn't that originally scheduled to last much longer?
Much longer, through 2032 under previous plans, so a very accelerated phase out for EVs as well.
Okay. Now, stepping slightly outside the bill itself for a moment, President Trump has also been active on trade, imposing new tariffs.
Oh.
How do those fit into this whole economic picture?
Right, the tariffs are a separate policy tool, but they're happening concurrently and have major economic effects that interact with the bill.
What's the scale of these new tariffs?
President Trump has imposed new tariffs on, believe it or not, over 70% of U.S. imports. It affects nearly all our trading partners.
70%. That's massive. What's the financial impact?
Well, on one hand, they're estimated to raise a lot of revenue, maybe $2.1 trillion between 2025 and 2034.
But there's always a cost, right?
Always. They're projected to reduce long-run U.S. economic output by about 0.7% and decrease average after-tax incomes by 1.2%.
Why the reduction if they raise revenue?
Because experts generally see them as a distortive way to raise revenue. They mess with supply chains, raise costs for businesses and consumers, and crucially, they often invite foreign retaliation, other countries putting tariffs on our goods.
Creating trade friction.
Exactly. A more complex and potentially damaging global trade environment.
Okay, so let's pull all these threads together. We have the tax cuts, largely permanent. We have new programs like the Trump accounts. We have changes to social safety nets. We have shifts in energy policy. And we have these broad tariffs. What does this all add up to for the big picture, for the national debt? This sounds like a lot of spending and reduced revenue.
It does add up. And the implications for the nation's finances are, well, they're quite stark.
How stark?
This bill, the OBBB, is projected to increase the federal deficit by an additional $3.4 trillion over the next decade.
$3.4 trillion added to the deficit, on top of what we already owe.
On top of the existing national debt, which, as you know, currently stands at a staggering $36.2 trillion.
So we're heading towards $40 trillion.
We're heading rapidly in that direction, yes.
What does that mean for everyday people, for businesses?
Higher deficits generally put upward pressure on interest rates. That means increased costs for mortgages, for car loans, for businesses trying to borrow and invest.
And for the government itself.
The government's own interest payments on the debt are projected to soar. They're expected to exceed $1 trillion per year soon.
$1 trillion just in interest payments.
Per year. To put that in perspective, consider this. An annual interest payment larger than our entire defense budget.
Larger than the defense budget. Let that sink in.
It's a staggering figure, and it really highlights how much of our future federal budget might just be eaten up servicing past debt rather than being available for, infrastructure, research, education, or anything else.
Wow, this one big, beautiful bill act.
Yeah.
It really is multifaceted, isn't it? It touches almost every area of our lives and the economy.
It truly does. It's a perfect snapshot, really, of the complex interplay between policy decisions, economics, and the real-world consequences that ripple out.
Yeah, it demonstrates how all these seemingly separate provisions, taxes, social programs, energy, weave together into one single profound shift in direction.
Indeed. And, this raises a really important question for you, the listener, to think about.
Which is?
How do you balance these things? How do you weigh the immediate, tangible benefits of maybe lower taxes or a new program like the Trump account against the potentially very serious long-term implications for the national debt, for interest rates, for the whole landscape of economic incentives?
That's the multi-trillion-dollar question, isn't it? Understanding those trade-offs, the short term versus the long term.
It's crucial for being a well-informed citizen, absolutely.
Well, it's definitely a lot to consider. But hopefully, this deep dive has given you, our listener, a clearer understanding of the key details and the potential implications of this really momentous legislation.
We hope so. It's complex stuff.
It is. All the best, and we will meet again with another important subject in the next meeting.